this is part 1, chapter 5. As you saw, the name of this chapter it said Introduction to Risk, Return, and the Historical Record. And as we talk about risk and return, particularly return, we have to focus on interest rates and the factors that impact interest rates, because that has a huge impact ultimately on the rate of return that we require and expect on certain types of assets. And so we begin with this slide talking about interest rate determinants, and it should come as no surprise to you that we're going to talk about supply and demand. Why does it say supply households and demand businesses? Well, really what we're talking about here is the supply of money and the demand for money. And it is mostly households that supply money to the capital markets. They do that. We as individuals do that whenever we put money in our banks, whenever we're buying certain securities, whenever we open up an investment account and buy securities, when we're buying treasury bills and treasury bonds from the government, when we're investing in mutual funds, we are supplying capital to the markets. Businesses certainly demand those funds. Businesses need those funds for expansion and growth. Okay. Certainly, we also have to take into account the government. The government can both demand funds and supply funds. I think we would probably agree that the government is probably more of a net demander of funds. The U.S. government does demand a lot of funds, don't they? They acquire their funds through tax revenues and also, though, through the continual and continuous selling of U.S. government bonds to raise capital. Okay, so the Federal Reserve actions, you probably remember from an economics class, that certainly is going to influence the supply of money. The Fed can increase the discount rate or decrease the discount rate. The Fed can change the Federal Reserve requirement, the reserve requirement, which is the percentage of funds that banks must keep on reserve with the Fed. If they wanted to affect the money supply, they could buy U.S. government securities or sell U.S. government securities. Let's just do some basics here. We're going to have some supply curves. Here's a supply curve, and here's our demand curve. And I'm going to put P and Q. And what we're talking about here is the supply of money and the demand of money. So here where I have P, that's the price of money, which is the interest rate, and Q is the quantity of money. Okay? Well, so we know that the equilibrium occurs when of a normal good when the supply curve and the demand curve cross. At this particular point here, this quantity, the suppliers will supply that much money at that price, and the demanders will demand that much money at that price. Okay? So how does supply impact the interest rates? Let's assume that the supply increases. Since quantity is increasing this direction, an increase in the money supply would cause the supply curve to shift to the right, and look where the two curves cross now. We would have a decrease in the price of money, which is the interest rates. On the other hand, what if we had a decrease in supply? The supply curve shifts to the left. A decrease in the supply of money holding demand constant would increase the price. Let's take a look at how demand impacts. Again, price, quantity, supply, demand. Okay, let's hold supply constant now, and let's assume that there's an increased demand for funds in the market. The market's heating up. Businesses feel good. Businesses want to start expanding. They need to start borrowing money so that they can expand. That increase in the demand for money, remember quantity increases to the right, that would push out the demand curve. Again, holding supply constant, if there's a greater demand, we would expect an increase in the price of money, which is the interest rate. If demand were to decline, then you can see we would expect interest rate levels to fall. Okay. Remember, your slide here does also, it talks about the Federal Reserve actions. And remember, the Federal Reserve, through their monetary tools, directly impact the supply of money. So again, let's hold demand constant. If the Fed decides to increase the money supply, remember, quantities increasing this way, increasing the money supply is going to lower the equilibrium price of money. If the Fed reduces or restricts the money supply, then the supply curve shifts to the left and would have a higher cost of interest, holding everything else constant. Okay. Well, we also need to make sure we know the difference between the nominal rate of interest and the real rate of interest. The nominal rate of interest is really the quoted rate of interest. If you borrow money from the bank and they charge you 5%, that's a nominal rate. It's the nominal quoted rate of interest. It's the growth rate of your money. If you started with $100 and you are going to earn 5% interest, that's a nominal rate. Your money is going to grow by 5% to 105. Okay? Does that mean you can buy more of the same good as you could purchase the year before or the period before? That depends, doesn't it? That depends upon the rate of inflation. Okay? The real rate of interest says, well, what's the growth rate of your purchasing power? Right? It's not so much that you started with 100 and you ended up with 105. It's how much will that 105 purchase today relative to what it would have purchased a period before. We have to take into account inflation. The real rate basically accounts for the fact that, yes, your money is growing. That is the growth rate of your money. But perhaps the cost of things is also rising. So what's the real rate that you've earned? Okay? And so we can calculate the real rate by using this formula here, where the real rate, lowercase r, is equal to big R, which is the nominal rate of interest, minus inflation, divided by 1 plus the inflation rate. Let's take an example. Let's assume the nominal rate is 10%. Let's assume that inflation is 6%. We can solve for the real rate. Yes, it's true. Your money's going to grow at 10%. But that's not real growth because of inflation. So if we take our 10% minus 6% divided by 1 plus inflation, that's going to give us 0.03774, I believe. I did this earlier, which would be 3.78, or about 3.77%. That's the real rate of growth after you take into account that your purchasing power has declined. Right? Holding a $1 constant, you could buy less with that same new dollar than you could have purchased the period before. So when we think about the real rate of interest, what are the determinants of the real rate? It's the same three things that we had a moment ago, plus now we have to take into account inflation. Absolutely, the supply of money, the demand for money, right? Government actions, all of those things are going to impact the real rate of interest, but certainly inflation. This slide shows us, again, the same idea, determination of that equilibrium real rate of interest. And there are a couple things that I want to point out here. I want you to notice the supply curve. The supply curve is upward sloping, isn't it? From the left to the right, it's upward sloping. And remember, let's say that this is the supply, okay? This is the supply of funds. Well, the supply of funds, and it's based upon the real rate of interest. Think about, we had an earlier slide where we said, really, who's supplying the funds to the market? Households are. And households are willing to supply more money to the market whenever the equilibrium or the real rate of interest is higher. So the higher the real rate, let's take this point right here, okay? at that level of real rate of interest, households are willing to supply a large amount, aren't they? If the real rate of return was very, very low, then there's not as much incentive to supply money to the market. Let's look at the demand side. This demand curve, as we can see, slopes down, doesn't it, from left to right. And let's see if that makes sense to us. Who's demanding money? Well, let's say businesses are. Aren't businesses going to demand more money whenever the interest rates are lower? I think so. So when there's a low cost, a low real interest rate, businesses are willing to, they demand more. They want to invest more. At higher interest rates, there's a much lower demand for those funds. Okay. So this slide is sharing with us really the relationship between inflation, the real rate, and the nominal rate. As inflation rate increases, investors are going to want a higher nominal rate of return. Well, that certainly makes sense, doesn't it? If we're expecting inflation to increase, that means we're going to lose purchasing power. All right? And so as a consumer, as an investor, we're going to demand, we're going to want a higher nominal rate of interest that's quoted to us. Right? That's all that the banks and the borrowers of capital can pay. They don't pay the real rate, they pay a nominal rate. And so if inflation is expected to increase, then we would expect nominal interest rates to also increase. Okay. It says EI, that's the expected inflation, our expectations of inflation. That really gives us what's called the Fisher equation. That shares with us, tells us that the nominal rate is really a function of the real rate and our expected inflation, our inflation forecast. Now, herein lies a real issue, a real problem for us investors, right? Because we know that when we have positive returns, we have a partner, right? In case you didn't know it, you have a partner, and your partner is the federal government. Your partner absolutely wants you to make money, because when you make money, you're making money for the partnership. When you make money, your partner says, way to go, partner, way to make me some money, way to make us some money. But then your partner says, where's my share? All right? Because your partner is expecting. Notice your partner doesn't say, what's my share? Because your partner wrote the partnership agreement, right? The old IRS. They wrote out the tax code. Here's the problem from our standpoint. We know that when we've got inflation, nominal interest rates are increasing. We just said that. The Fisher effect says that if we expect inflation to go up, then as investors, we want a higher nominal rate. Okay? As our nominal rates increase, who's happy? Well, we are, and our partners are happy, the government. Because the partner says, way to go, dog, way to go, partner, look at that. We're making more money this period. Keep in mind that some of that money that we're making is simply because of inflation. Okay? But our tax liabilities are not based upon the real rate. That's really what it ought to be based on. It's based upon the nominal rates. The nominal rates. Pretty good example on page 121 if you want to go back and look at it. But it's something along these lines. Let's say that you can earn 12%. You can earn 12%. In this example, inflation is 8%. And the tax rate is 30%. Tax rate is 30%. All right? So let's assume then again that we earned 12% rate of return. Here's our 12% rate. Our government, our partner, because the tax rate is 30%, our partner gets 30% of that. So we only get to keep 1 minus 30% of that, which is 70%. So of the 12% that we earn for the partnership, we get to keep 8.4%. Well, gosh, if inflation is 8% and we get to keep 8.4%, then we had, after taxes and after adjusting for inflation, we have less than 0.5% rate of return. We had a 0.4% return, didn't we? So the real, or the after-tax real rate of return falls as inflation rises. Thank goodness inflation was only 8%. If inflation had been 9%, we would have been worse, wouldn't we? We actually would have lost purchasing power. We would have been better off not to make an investment at all. So what we see here is it says, as the after-tax real return, it says it falls as inflation rises. Okay, so the real return goes down. We already know that as inflation rises. So the after-tax rate of return, the real after-tax rate of return goes down, as this says, as inflation rises. Okay. All right, so next thing your textbook does, it walks through some scenarios, and we're going to use this to understand a little bit about interest rates and compounding, and we're going to make a distinction between something called the effective annual rate versus simply the annual percentage rate. APR versus effective annual rate. The main difference, and I'll just write it here and then we'll work these slides here, is that the annual percentage rate does not take into account compounding. So I'm going to put no compounding. Whereas the effective annual rate does take into account compounding. Some of you may remember from a previous course, maybe a the finance principles course, where perhaps you saw for bonds and bond values and yield to maturity. Okay, you may remember that if you had a bond that was a semi-annual bond, and let's say you saw for the yield to maturity, and let's say the semi-annual yield was 3%. Well, how do you annualize it? Well, we simply multiplied it times 2 to get 6%, and that was the annual yield. Right? That doesn't take into a compounding, does it? That's what we're going to do with the annual percentage rate. If we solve for a quarterly rate, we will simply take it and multiply times 4. If we solve for a semi-annual rate, we'll simply take that rate and we'll multiply it times 2. All right? So that's the annual percentage rate. Effective annual rate, what we're going to do is we're actually going to compound. So I want you to remember this formula. I'm going to write it down if I need to, but we need to get to the next slide here. And let's see what I can do here. Let's see. Whoa, that's not what I'm looking to do. Sure wish that hadn't happened. There we go. Let's try that again. It's not letting me do what I want to do. So never mind. So that formula that was on the previous page, let me go back to my pen, go back to red here. We had something that looked like the rate of return. We're going to take 100 divided by the price minus 1. All right. So they say here, suppose that the prices of 0 coupon treasuries with a $100 face value in various maturities, they are as follows. And what we're going to do is find the rate of return. All right. And so, for instance, for the first one, it says it's a half a year. Well, the price is $97.36. So if we take 100 divided by 97.36 and subtract 1, we're going to get 0.0271. Now that's a half year, isn't it? So the semi-annual rate, because this is a bond that has half a year until it matures, if we buy that bond for $97.36, we hold it for 6 months, it's going to grow to 100. Essentially, the rate of return we're going to earn during that 6-month time period is 2.71%. Okay? That's the rate. That's not an annualized rate. That's simply the rate over that over that 6-month period. Let's take the next one. It's a 1-year horizon. So if we take $100 divided by the price, which is $95.52, and subtract 1, you see on our table here, we're going to get 0.0469. So 4.69% really is that rate. Because this is 1 year, that's equivalent to a 4.69% annual rate. Right? So far, so good, I hope. Now I'm going to skip that last one here for just a moment. Now let's take this number here. That was the 6-month number. And we know that that's a 6 month, but we need to annualize it. There's two things we could do to annualize that rate. We could either take into account compounding or not take into account compounding. If we do not take into account compounding, we could calculate what's called the annual percentage rate. And the annual percentage rate is going to be our 0.0271. That's what we would earn over 2 periods. That's what we would earn over a 6-month time period. And let's simply multiply that times 2. If we do that, that looks like it's going to be about 542, I believe. Let me take a look here. 2.71, 2 times 5.42%. 5.42% would simply be, or that would be, the annual percentage rate. But as you know, as you can see, that does not take into account compounding. So if we wanted to take into account compounding, we're going to solve for the effective annual rate. And that's on our next page here, I think. Let's go to that page. The effective annual rate. Man, this looks hard. But it's really not. Okay? What we're going to do is take, again, it gets kind of confusing here, but in our previous example, where it was 6 months, 6 months, T was equal to the number of years, it was equal to 0.5. Right? It was 1/2 of a year. And so we take 1 plus the rate that we had calculated, 1.0271. Right? 1.0271. And we're going to raise that to the 1 over t power. Well, since t is equal to 0.5, 1 over t is equal to 2. So I'm going to raise that to the 2nd power. And then subtract 1, and that's going to give me my effective annual rate. So 1.0271 raised to the 2nd power, subtract 1, I get 5.49%. Or 0.0549, which is 5.49%. Okay. So if you remember on our previous page, I had the annual percentage rate was equal to 2.71 times 2 to get 5.42%. But here we're seeing the effective annual rate is 5.49%. That is, if we earn 2.71% in the first 6 months, and then earned another 2.71% in the second 6 months, we're actually going to grow more because we've got compounding. We will earn interest on the interest. So that's a difference between the effective annual rate, which takes into account compounding, and the annual percentage rate, which does not. Okay, I'm really not too interested in you converting, annual percentage rate to effective or effective to annual percentage rate. So I'm not that interested in this formula. I do want you to remember that annual percentage rate, you're simply going to multiply times 2 if it was a semi-annual rate. If it was quarterly, you'll multiply times 4. If it was monthly, you'd multiply times 12. So no compounding. The effective annual rate, yes, compounding. I'm not very concerned about us understanding too much about continuous compounding, or more specifically applying continuous compounding. But I do want to point out one thing from this table. If you'll notice, as we go down this list here, we start with 1 year, right? So that would be annual compounding. And then every 6 months, that's semi-annually, quarterly, monthly, weekly, daily, okay? And so we went from having 1 compounding period per year to 2 to 4 to 12 to approximately 52 to 365 approximately. Okay. And so what we see, though, is that the effective annual rate, right, of 5.8%, 5.8% compounded annually is 5.8. 5.8% compounded semi-annually, actually the effective annual rate is higher. It's 5.884. And remember, that's because you're earning interest on the interest. The more times per year that you have compounding, the more number of periods in which there are for compounding, whether, from quarterly to monthly to weekly, we're compounding more times per year. The effective annual rate is going to increase. Because basically, the more compounding periods there are a year, the sooner you're credited with the interest that you've earned, which means that interest can start earning interest even sooner. Okay. Let's take a look at this slide, and I want you to see the relationship between inflation and T-bills. For all years, 1926 through 2009, it says the average annual rate. So for that 84-year period, I think it's 84. 84 doesn't seem right, but 83 perhaps, whatever. Okay. T-bills averaged 3.7 and inflation averaged 3.1, for goodness sakes. Wow. So actually the real rate was certainly, you didn't really earn 3.71% on a real basis, did you? If 3% approximately was inflation. In fact, we see the real rate on T-bills on average during that time period. Okay. So what does that mean? Well, number one, T-bills aren't going to allow you to grow very much anyway. That's only an average of 3.71. And so somebody that was using T-bills to save for retirement, probably may not have accumulated the amount of money that they had anticipated. But even if they did, since inflation was 3.1 during that same time period on average, their real rate of growth was less than 1%. So in terms of purchasing power, wow, they didn't earn very much at all, did they? Okay. In fact, on the next slide, we're going to see something kind of interesting. Well, let's just go take a look here. It says moderate inflation can offset most of the nominal gains on low-risk investment. So if you had invested $1 in T-bills, okay, so let's say from 1926. In 1926, great-grandpa invested $1. By 2009, the real value, right, it says it grew to $20.52. But that's very misleading. because the real value is only $1.69. It's only $1.69 after you take into account inflation. Now this also says, and I want to remind you of something, we know that the real rate is approximately the nominal rate minus inflation. That's approximately the relationship. And so if inflation goes up, holding the nominal rate constant, which we shouldn't do, but if we did, if inflation goes up, the real rate is going to go down. That's a negative correlation, isn't it, between the real rate and inflation? And so what they're telling us that means then is that the nominal rate responds less than 1-to-1 to changes in inflation. Here's a slide that shows us a positive correlation between inflation and interest rates. Inflation in the light blue, and so we can see when inflation tends to be going up, well, there's not so much for the time period that I selected, but let's take from here on. From about 1950, if you'll notice, as inflation is going up, T-bill rates were going up. And when inflation went down, T-bill rates tended to follow. So there's a strong positive correlation between inflation and our interest rates. Okay, I'm going to stop here. That will be the end of Part 1, Chapter 5.